Why are mortgage rates still so high? This is a question that I want to, dive into today and really look at because it's an issue that's affecting all Americans, whether they're ready to buy their first house, looking at it, hoping for it, or just wanting to move. The housing market's been pretty stagnant over the past few years, and mortgage rates are a main contributor to that.
Yeah, we've recorded podcasts on mortgage rates, housing market dynamics before. And I think it's interesting because there's been this anticipation, a lot of consumers, people hoping to buy houses on the sidelines, really wanting to get into the market, but they've been waiting for these mortgage rates to come down, which they really haven't. I mean, the 30-year mortgage average rate's sitting at around 6.9%, so just under the 7% mark. And it's really held in that range, very close to that, since October of 2022. So I want to get into the dynamics today, give our listeners some things to think about, how we're viewing mortgage rates and the reasons why they really have been so range bound when we've been talking about the Fed's cutting cycle and all the interest rate dynamics that really play into that.
Yeah. And so kind of as a starting point, give our listeners some kind of idea of how these mortgage rates are built. Essentially, where does the rate come from? It's not just some kind of arbitrary market rate. It's based on the U.S. 10-year Treasury plus some kind of spread. Part of the issue right now is that spread's wider than normal. We'll get into all the details later, but 10-year Treasury plus a spread of about 2.5% right now. And one thing that I think is interesting to point out is that this is for a 30-year mortgage. We're using the 10-year rate. So this is kind of two big reasons there. One, mortgages don't last 30 years generally. Most people move, most people refinance throughout the life of the mortgage. So 10 years is a much better ballpark for the expected duration that it's actually going to last instead of the whole 30 years. And then additionally, if we want to talk a little more financially, the actual money duration is closer to that like 15-year mark. And because the US 10-year is so liquid, that makes a lot of sense to use kind of as a starting point.
Yeah, exactly. And I think it's interesting to see how that spread is kind of developed. I mean, you're usually talking about 200 basis points, 2 to 2.5% over that 10-year Treasury rate. And so whenever we talk about mortgages, we can also talk about how they've been range bound. We can also talk about how the 10-year has been fairly range bound since the Fed has really started the rate hiking cycle. Now we're in a cutting cycle, but it's really so much of the Fed dynamic that is driving those interest rates and impacting that 10-year, which, to that end is impacting mortgage rates. And the thing is, the Fed has been slower to cut rates than previously anticipated. Of course, longer term interest rates, especially US Treasury yields, will anticipate Fed action because they're only controlling the very, very shortest term, those overnight rates that banks are lending at. And that's going to impact things downstream, but it's a lot about market perception of what is going on with the Fed rate and where that's going to land in the future. And what we've seen is while the market really anticipated more Fed cuts up front, they've been slower to do that. I mean, we went into the year really thinking, or kind of middle of last year, we're thinking, hey, 2025, you're probably going to see a full percentage point of cuts. Now that we're in 2025, it's looking like maybe 0.5% of cuts or potentially only 125 basis point or 0.25% cut. So that trickles down the Treasury curve. And so whenever you're talking about that 10-year rate and mortgage rates, it's really kept them elevated. And of course, we've talked about this on prior podcasts, but that's a lot because of stickier inflation.
Yeah, inflation has stayed higher than the Fed wants it to be. They're trying to continue to put downward pressure on the economy. And that's through higher interest rates, slows things down a bit to try and get inflation down to that point. The Fed and Jerome Powell still believe where we're at is sufficiently restrictive. We are making progress towards that, where rates are currently at. So there have been a few market participants talking about the possibility of rate hikes. We're not seeing the need for that yet. Neither is Jerome Powell from the sound of it. We're still, like you said, anticipating 1 or 2 rate cuts this year, but those, the more we talk about it, the further those get pushed out. We're looking at second half of the year. Maybe if we get a second one, that'll probably be in November, December timeframe, so really, really pushing the cutting cycle out, which to your point will leave those kind of mid and longer term rates more elevated.
Yeah, and we've been talking about inflation a lot on recent podcasts, and I think you and I still kind of anticipate that over a longer period of time, inflation's still going to come down to that Fed's 2% target, but it has kind of held up in the near term. That's been a variety of dynamics behind that. Maybe we'll have a podcast on all the inflation dynamics in the future, but I think it's really interesting to kind of view it through that lens as far as where the Fed action's going. Now, another part of this really interesting dynamic, and hopefully our listeners think this is interesting. I'll keep it, fairly high level because can get kind of technical, but mortgages are they're issued predominantly by banks who want to offload the risk of those mortgages. And of course, everyone is familiar with mortgage-backed securities, probably because of what happened in 2008 when there are so many subprime mortgages going into mortgage-backed securities. But those are still utilized to a large extent in order for banks to offload some of the risk of individual mortgages from their balance sheet. And so what banks do is they package all these mortgages into a debt security that's going to pay, an end investor based off of the mortgage payments from the people that own these homes and are paying these mortgages. Well, part of the reason why mortgage rates can stay elevated is depending on the demand for those mortgage-backed securities. So if you're an investor looking for an MBS, but you're not super eager, there's not a lot of demand to buy up these mortgage-backed securities, well, in order for banks to be able to sell them, they need to make sure that the mortgage rates underlying are yielding high enough to issue those securities for investors to have enough demand. And so what we've seen recently is that mortgage-backed securities, agency mortgage-backed securities have higher spreads. You were talking about spreads over a Treasury yield, have had historically high spreads because there isn't so much demand there. Now, going back to the Federal Reserve, during times of quantitative easing, when they're putting money into the financial system, they will actually buy mortgage-backed securities. But right now they're doing the opposite because they're trying to tighten lending. They're trying to pull money out of the financial system to slow that inflation. And so part of that is offloading the mortgage-backed securities that are currently on their balance sheet. So they're not a source of demand for MBS right now. They're actually the opposite. They're not so much selling mortgage-backed securities actively into the market, but they're letting them roll off their balance sheet. They're not a buyer. So that's contributing to the whole story, and something that frankly I hadn't thought a whole lot about before doing research for this podcast. But the mortgage-backed security dynamic is really interesting and something that does impact the underlying.
Yeah, no, this is super important part of this whole thing. And very similarly, something that we haven't touched on is that a similar thing is kind of going on with, your medium long-term rates from the US Treasury point of view, is that if the US Treasury is, putting out a lot of debt, issuing a lot of these securities, then, are there buyers for those? It's not so much that people, there's been a lot of talk about the deficit and everything, but it's not so much that people are concerned that the US government's not going to be able to pay it, at least not right now. It's the fact that when you are issuing a lot of debt, you're putting a lot of, issuance out there and somebody has to buy it. Otherwise, the rate goes up to incentivize people to buy it. So, in order to issue all of that debt, these medium long-term rates are pushed up. And so you see a very similar thing happening with MBS, which I think is really interesting. And then going kind of from that aside is that a lot of banks have been kind of pulling back over recent years also because there's been a lot of regulation uncertainty out there. You have the Basel III endgame regulations, which really is just, sounds fancy, complicated, whatever, but it's just a set of regulations that govern, capital requirements for banks. How safe do these banks need to position themselves? And that involves saving more than they're lending out. So if you have a lot of deposits at your bank, you can only lend out a smaller portion because of that. Also, lending those out at higher rates makes it a safer investment. So from a few different angles, banks are being incentivized right now to not lend out, at least not lend out at lower rates. And so as long as the market will bear a 2 to 2.5% mortgage spread, they're going to take it.
Yeah, no, that's exactly right. And I think that it's interesting to see the varying dynamics when it comes to, I mean, of course, you're thinking about broader interest rates, but you do have to consider the lending dynamics as well, because you've got both pieces of that, both sides of that coin, if you will. You've got the, broader market for interest rates, and then you've got the lending dynamics that impact the lenders and what they're willing to lend money out at. Part of that is the fact that the housing market has been pretty tight over the last few years. I mean, you don't have a lot of existing homes entering the market. We've talked before about the golden handcuffs of these, 2-3% mortgages, where homeowners don't want to leave because they're tied into this super low mortgage rate. So you just don't have a lot of existing homes entering the market. And when lenders are only able to issue so many mortgages, well, of course, they're going to want to get a higher spread. They're going to want to be able to charge a higher interest rate because they're being conservative in their lending. So you've got the combination of the bank lending standards, the regulation question mark, and the fact that there's just not a lot of inventory. If you're turning over mortgages extremely fast, well, yeah, maybe you can offer it at a slightly lower mortgage rate. But when you only have so much availability that you can lend to, then it requires you, or at least, pushes you to lend at a slightly higher mortgage rate. So that's another important dynamic I think, people should pay attention to.
Yeah, it certainly is. So we have the problem. We've talked about the reasons why. Let's get into some solutions, perhaps. I mean, there's only so much that you can do from the consumer side, but there are legitimate steps that you can take to, lower your potential mortgage rate, to set yourself up for success in various different ways. And so to kick that off, there's, the kind of baseline of all of this is your credit score. You go in looking for a loan of any kind, and that's probably the first thing that they're going to look at. And so while it's not going to be an overnight thing, it's going to take a while. But if you're looking at either moving in the next couple of years or potentially looking to enter the market for your first home in a few years, maybe, even 1 year from now, there's steps you can take in the meantime to set yourself up for success in that way. That's not applying for a bunch of credit cards and having, people ping your credit, because every time someone pulls your credit, that's a knock against you. Those roll off your credit score after a year. So don't go get a new credit card right before you apply for a mortgage, something like that. It's little stuff, but it really helps. It's pay your bills on time. Don't carry large credit card balances if you need to do, there are a lot of strategies around balance transfers or something to help pay that down, but start making those steps as soon as possible just to set yourself up for success.
Yeah. And I think a lot of these strategies that we're going to talk about involve preparing ahead of time. And I think it's something to always be cognizant of. Of course, your credit score, you always want to be on top of that if you can, and be intentional about whenever you're seeking new forms of credit, whether it be a credit card, a loan, try to consolidate that as much as possible. And of course, pay off your highest interest rate debt first. Typically that's credit card debt, if anybody has that. I think another thing is, for anyone who's been maybe on the sidelines of this market, they've been saving up money for a house. Maybe they have enough to cover that initial down payment, and they've continued to save more, waiting for mortgage rates to change. There's always the option of paying more on your down payment on your house whenever you make that purchase, because one, that's going to lower your overall just interest or your mortgage payment. on a month to month basis. So if you're considering, your month to month, obligation to your mortgage, it's going to lower that. But you can also kind of look at it as an investment, because say your mortgage rate's going to be 7% right now. Well, that's essentially a guaranteed 7% return on that money that you make as a down payment. You're not paying interest on that. So you can kind of look at it as if you're investing it, just in equity of your house. If you live in a good market where you anticipate house price appreciation, well, then you can feel pretty good about allocating that to equity in your house. You're not having to pay that 7% mortgage. So maybe instead of 15% down payment, you do 20% or maybe 25%. Of course, home prices have gotten expensive. So I, obviously recognize the fact that just the down payment can be difficult for a lot of people. But if you have the means to do it, that's another option as far as limiting your interest payment on a month-to-month basis.
And then along with that, if you can't afford to do it now, you can get some of those benefits by overpaying your mortgage down the road. Obviously you're not going to get the better mortgage terms up front that you might get from a larger down payment. But if you're, down the road, you're seeing, oh, well, I have a 7% mortgage and I'm holding some like 5% bonds in my account. Well, it makes more sense than to pay your mortgage and then not pay the tax on your 5% bond income as well. Just as a little aside, one other step to take is to look at all of your different financing options, because mortgages don't just come in 30-year fixed. There are shorter term mortgages that will come with a higher payment per month, but 15 years are very common in Europe. They're a lot less common in the US, but that is obviously going to drive your mortgage rate down. Again, higher payments, you're consolidating the time you're paying it back over, half the time. So that is going to be a lot more difficult for a lot of people, but depending on your situation, if you can't put as much down, but your earnings are high, you don't have a lot of savings, but you're a high earner, maybe that's something to consider, as well as adjustable rate mortgages. You can get still a 30-year, but it's a fixed rate for 5 or 10 years, somewhere in there. There are a few options, and then it is floating after that time period. And those work very similarly. Like we said, most people don't stay in their homes for the full 30-year span. And then also in the current market environment, with rates probably going to be lower in the future than they are right now. I mean, that's always, up for debate and, uncertain, but, that's kind of where we feel like the market's going. Rates are going to be lower 5 years from now than they are now, barring some sort of black swan. Well, then maybe it makes sense to go into an ARM, which is actually a lower interest rate right now because you're taking a little bit of risk later on. You can always refinance those as well.
Right. Yeah. I think that's the important thing to recognize is that whenever you take on a mortgage, of course, those initiation fees and things like that, you don't want to be refinancing every single year. Unless, there's a huge drop in interest rates, say, during COVID or something like that. And it really makes financial sense. But, every, 4 or 5 years certainly is going to, pay for itself if you're getting a substantially lower rate. Now, speaking of 4 to 5 year timeframes, I think another option for people is to buy down your interest rate, typically, by buying points, or they call them points traditionally. So every point is, roughly, a 0.25% interest, decrease on your mortgage payment. And it adds about 1% to the principal of the mortgage. Well, if you kind of break that up, that's about, 0.25% per year. Well, that's, maybe 4 years of payment. So if you're going to be in your house for at least 4 years, I mean, I'd say very minimum, you want to be in there probably, 5 years, or anticipate being in there for 5 years, then it may make sense to buy down that payment to that mortgage rate to some extent, just because you're going to be paying a little bit lower month to month because that interest burden is going to be less. Of course, it is adding to the principal. So you have to think about, hey, that's not all necessarily equity value whenever you're talking about your broader mortgage. But sometimes it's a strategy if you're kind of on the cusp and thinking about, hey, how much do I want to be really, paying an interest every month versus, paying to the broader mortgage. Buying down that rate can make sense, especially if you anticipate being in your house for a long period of time.
Yeah, it certainly does. And one thing I would add there is just that you would probably like to be in your house closer to 8 to 10 years to actually get some return on this money. Because
Right.
otherwise, you can break even, but time value of those 4 or 5 years, not really doing anything for you. But that's kind of a good time frame to keep in mind. Bare minimum, I want to be in this house for, call it 4.5 years, to make sure it makes sense. Um, and one additional thing with that, and it leads me into my next point, is you do lose your points if you refinance. So if mortgage rates drop precipitously, then it makes sense to refinance. That means that you're going to lose those points that you paid for, but it can still make a lot of sense. And, that's something that I know a lot of people in the marketplace are hoping for. They're kind of bearing through their 6, 7% mortgage rate right now, hoping that maybe in the next 2, 3 years, mortgage rates will come back down, not to the real low 2, 3% that we've seen in previous years, but come down enough that they can just bear it out in this meantime and then refinance closer to 5, high fours, maybe. Fingers crossed there.
Yeah, and I think as we talk about this too, it's there's a lot of dynamics that play into this, and it's worth seeking some financial advice potentially if you're going to take on a fairly substantial mortgage, because part of it too is, of course, tax regulation of laws is kind of up in the air, from administration to administration, but interest interest on your mortgage is tax deductible. So sometimes, I'm not saying you want to pay more interest. Of course, you don't want to pay more interest, but if you can, pay interest instead of, adding on to your mortgage, sometimes that kind of makes sense because um, you get the tax deductibility of that mortgage interest, and so it brings down your taxable income. You're paying lower taxes to the federal government that way. You have to consider all of these things whenever you're talking about mortgages and loans. But I think it's important for individuals to keep in mind that is a benefit. That's something that you don't get whenever you're renting versus buying. Of course, when you buy, you're building equity in the home. You also get the tax deductibility of the interest, which you don't get from a rental. So something to think about whenever people are considering mortgages. Kind of getting back to the strategy piece of it, it's worth shopping lenders whenever you're going and looking for a mortgage, because different companies are going to look at individuals differently depending on the current mortgages on their books, what they're looking for risk, whether it's the, value of the home or the area of the country that the home exists in. So it may make sense to just check with a few lenders before you go with a mortgage, because every basis point, 1/100% of interest that you can save can make a pretty material amount of difference over the life of that mortgage. It's especially where home prices are now, really trying to save on that interest rate, and of course still going to a quality lender if that's important. You want to be with a good bank who's going to work with you. But shopping for lenders, I think, is a valuable piece of that maybe not everyone's going to think, oh, maybe I'll just go to my local bank and I'll get what I get. Well, it can definitely vary between lenders. So it's worth checking with a few before signing on to a mortgage.
Yeah, this can be one of your best returns on time invested. Go get a few quotes. It doesn't really take that long, but you're able to, find, because maybe your local bank is very localized to this region and has just so much exposure to this one economy that maybe they're trying to diversify and they don't really want more loans in this one specific area that you live in. Well, they're going to price it a lot higher than another bank that's trying to enter this market where you want to live. So people have their own, beyond the broad economics, they have their own, supply demand constraints here and like their own priorities that will dictate, kind of what incentives that they can give you to bank with them instead of somebody else. And then short of banking with somebody, there are other alternatives to consider. I mean, so when I say renting, most people probably think of apartments, or not condos, but apartments, multifamily type projects, duplexes. The home rental market is a very real and alive thing. And sometimes that can make a lot of sense. You don't have to put a bunch of money down initially. It saves that money. If you want to keep that invested or, just growing on the side and then just paying rent, not having to worry about maintenance, that's something I've personally discovered over the past couple of years of owning my first house, is that the maintenance costs are significantly higher than you would think they are, or think they would be. And that's something that you can avoid a lot of times in home rentals, because depending on how that contract is structured, a lot of times the landlord is responsible for repairs. So, insulating yourself from that perspective removes a lot of the insurance burden from you as well. So there are pros to it. Like you said, Victor, you're not building equity, and there are benefits to owning a home, but renting is actually cheaper right now, given where mortgage rates are. Historically, buying is a little bit cheaper than renting, but over the past few years, we've kind of seen that inversion in the graph there of renting is now cheaper. Which also, if you want, and you're maybe in a position to rent, but you kind of want to eventually own your home, there are a lot of rent to own, like strategies, out there right now. You see this a lot with, you hear like Blackstone owns so many single family homes. Well, they're big in the space of they'll buy a home and rent it to you. And then so you pay rent, and you can kind of pay towards eventually buying it. Kind of your down payment gets paid into it. And then at the end of your lease term, whether it's 5 years, 10 years, you have that option to purchase the home formally, and then ownership transitions to you. So, it's a little bit more complicated, but it kind of allows you to ease your way into home ownership, which, depending on the situation, might be a good path to at least consider.
Right. It gives you kind of an opportunity to try before you buy necessarily. So you get to live in the home, experience it, and then down the road you have the option of whether you want to buy it or not. So I think that's an interesting new strategy that's becoming more common these days. There are more single family homes to rent and or rent to own, which is really interesting. It's an interesting dynamic in the marketplace, especially given what we've talked about with people being so locked in their homes. Existing homes are just, not so much for sale these days. And then, finally, I think timing your purchase is something that people should consider. Of course, we've talked about interest rate dynamics, how we expect them to come down in the future. I'd say, especially a year from now, I would anticipate lower mortgage rates. Now, of course, there's no promises in financial markets and complicated economic situations, especially like the housing market. But I think you're going to be in a better environment a year from now. I think every year that we get further away from these mortgages that got locked in during COVID, these 2-3% mortgages we've been talking about, the existing home market is going to get better. And we also have a lot of new homes coming online at the same time. So you're getting fresh inventory that's going to help those mortgage rate dynamics. And so if you're thinking about buying a home, you're still wondering if it makes sense. And if you're pretty happy where you're at right now, you can just wait it out a little bit longer and kind of see how the market plays out. I think the benefit is that I wouldn't anticipate mortgage rates going significantly higher from here. I mean, you could float around this high 6s to low 7% range for another, maybe 6 months or so, but I don't anticipate mortgage rates jumping to 8% or something like that outside of some unforeseen kind of black swan event. So I think people can at least, rest somewhat assured that they don't need a rush to make a decision. If you can be patient, you can be patient. And so I think that's also a benefit there.
Yeah, no, that's a great point. And really, I think the takeaway from all this is that the housing market's very complicated, very complex, because we haven't even touched on home prices. We have in previous episodes, but that's a whole separate, half of it. That's the other half of the whole, equation here. And so I think it's just a matter of, taking it slow, looking at all of your options, spend some time looking at it, because this is a lot of money, and little changes can make huge differences. So, take your time, look around, read what you can, and, consult with a financial advisor if you have one, or somebody that you can talk to who has done it before, kind of knows the environment. I think that's really important.
Yeah, absolutely. Buying a home may be the biggest financial decision of your entire life. So definitely not something to take lightly. But hopefully we gave our audience something to think about today. Some new information, hopefully, on the interest rate and mortgage rate dynamic side, especially some things that even surprised me that I thought were really interesting. Looking at that combination of where those government interest rates, those government yields, and then what are the dynamics behind the lender, and then also some strategies, some advice for, hey, how can I get the most out of my mortgage whenever I do seek one? How do I find that lowest rate that's still attractive to me? So I guess we'll leave it there.
Yeah. Thanks, Victor.